12 million ounces. That's what JPMorgan moved. Physical silver, actual bars out of COMEX vaults, right at that $83.90 price point. Not paper contracts, not futures, not promises. Real metal, changing hands, being pulled off the exchange while most people were fixated on the Iran war headlines and a crashing stock market. And here's what I need you to sit with for a moment. That price, $83.90, that's not where silver is going. That's where it was when someone who paid a $920 million fine for manipulating this exact market decided to go all in on the physical side. So why is the world's most powerful bank suddenly grabbing every ounce it can get its hands on? And why right now? Stick with me because I've spent the last 48 hours going through COMEX delivery reports, CME warehouse filings, and geopolitical data, and what I'm about to walk you through is not a theory. It's documented. It's numbered. And by the end of this video, you are going to understand exactly what JPMorgan sees that the paper market is desperately trying to hide. Let me start with the context because you need to understand the world silver is trading in right now. As of this week, March 13th, 2026, silver is sitting in a range between $83 and $88 an ounce, depending on the hour. That sounds like a lot compared to where it was 2 years ago at $28. But here's the thing that has every serious metals analyst I follow absolutely riveted. On March 1st, silver touched $95.85. Gold was testing $5,400 simultaneously. Oil spiked 13% in a single session to $82 a barrel. And the reason for all of that was two words: Iran war. On February 28, 2026, the United States and Israel launched coordinated strikes on more than 2,000 targets inside Iran. Supreme Leader Khamenei was killed on day one. Iranian retaliation was immediate and severe. Ballistic missiles hit Israel, Qatar, the UAE, Kuwait, and Bahrain. Iranian naval forces moved to shut the Strait of Hormuz, the narrow waterway through which 20% of the world's daily oil supply flows. 150 freight ships went dead in the water. Goldman Sachs published an emergency note on March 1st pricing an $18 per barrel war risk premium into crude. Wood Mackenzie warned of $100 oil if the closure persisted. And by Monday morning, markets opened in full panic mode. Silver's initial reaction? A spike to $95.85, within striking distance of triple digits. Gold tested $5,400. The war premium was real, it was visible, and it made perfect sense. Every energy shock in modern history has been a catalyst for precious metals. 1973, 1979, 1990, 2022. This was no different. But then something strange happened. Within 48 hours, silver collapsed 13%. Not because the war ended, not because the strait reopened. As of right now, today, the IRGC is still firing on and stopping vessels in the Strait of Hormuz. The IEA just agreed on March 11th to release a record 400 million barrels of crude reserves to offset the disruption, the largest strategic reserve release in history. The war is still happening. The risk is still real. And yet silver crashed from $95.85 back down to the $83–84 range. So what happened? Paper traders happened. Speculative futures traders who built leveraged long positions during the January-February rally used the war spike as their exit point. They sold into the panic buyers. Stop-loss orders cascaded. The paper price got hammered. And right at that $83.90 level, exactly where retail panic was setting in, the CME delivery data tells a completely different story. Because while paper traders were dumping contracts, JPMorgan was doing the opposite. They were taking the metal. And I'm not speculating about this. This is in the COMEX issues and stops reports. These are public filings. You can pull them yourself at cmegroup.com. Let me walk you through exactly what they show. Quick thing before I go further. My analytics show about 3 out of 4 people watching this channel aren't subscribed yet. If this kind of data-driven analysis is cutting through the noise for you, because there's a lot of noise right now, hit subscribe. That's how I know who the serious community is. It helps the algorithm get this to the people who genuinely need to see it. And frankly, the next few months in this market are going to be unlike anything we've seen since the 1980s. You want to be here for what's coming. Okay, back to the data. Let me give you the full picture of what's been happening at COMEX, because the JPMorgan move doesn't make sense in isolation. You need the scale of what's been happening behind the scenes. In January 2026, traditionally a quiet month for silver delivery, COMEX processed 49.4 million ounces of physical silver delivery. That's not a typo. 49.4 million ounces. To put that in perspective, that was 4.17 times higher than January 2025. It was 7.27 times higher than January 2024, and it was the sixth largest delivery month in the entire recorded history of the exchange, during a month that historically averages between 1 and 2 million ounces delivered. February continued. 25.18 million ounces delivered, the highest February total in modern COMEX history. And then March arrived. As of the first notice day for March delivery, 10,526 contracts were standing for physical silver. That's 52.63 million ounces demanding real bars, not cash settlement. Set that against the registered inventory, the metal actually available for delivery, which according to CME data stands at approximately 86 million ounces. And here's the number that made analysts genuinely alarmed. COMEX has now delivered the equivalent of 86.4% of its current registered inventory in just 60 days. 60 days. Think about that as a bathtub. The faucet, new silver flowing into vaults, is running at a modest trickle, and someone has been pulling the plug for 2 months straight. The water level isn't going to stay where it is. Now let's zoom into JPMorgan specifically, because this is where the story gets genuinely extraordinary. On January 7, 2026, the CME delivery report shows JPMorgan issuing 99% of the day's 8.1 million ounces in delivery notices through 1,624 contracts in a single session. But here's the detail that floored me when I first read it. That same day, January open interest on the silver contract actually increased by 1,431 contracts, even while those deliveries were processing. In a normal market, taking delivery drains open interest. The fact that interest increased while JPMorgan was taking maximum delivery means new buyers were piling in simultaneously. That's not normal market mechanics. That's a signal that the people closest to the physical supply are racing to secure metal before it's gone. And understand the broader context of what JPMorgan is doing here. This is the same institution that in 2020 paid a record $920 million fine, the largest precious metals manipulation settlement in U.S. history, for spoofing and manipulating the exact same market. For years, they ran what prosecutors described as a massive short position, pressing silver prices down. Now, according to multiple independent analyses of the CME delivery data, they've executed what analysts are calling a complete strategic reversal. From short and suppress to standing for maximum physical delivery. One of those analysts writing for Pareto Investor put it plainly. The first delivery report of 2026 shows a clear strategic pivot. JPMorgan went from being the entity most associated with suppressing silver prices to being the entity most aggressively acquiring the physical metal. Why would you do that? Why would you pay nearly $1 billion in fines for your old strategy and then spend billions acquiring the exact metal you used to suppress? Because your models now tell you the suppression is structurally impossible to maintain. Because the physical is about to become worth far more than the paper. And because history shows, every single time, that the institutions who know the most about a market's internal mechanics always position themselves before the crowd figures it out. Now here's where it gets interesting. The war premium angle. When silver spiked to $95.85 on March 2nd, that was pure war premium. Geopolitical fear driving speculative money into precious metals. Completely understandable. But the 13% crash that followed confused a lot of people, because the war didn't end. What happened instead was profit-taking by the speculative futures crowd that had ridden the January-February rally from around $72 all the way up toward $96. They used the war spike as an exit ramp, clean, logical, and exactly what large funds do after a 30% run in 2 months. But here's what I need you to understand about that distinction. The paper traders who sold at $95 were pricing in a short-term geopolitical risk event. JPMorgan, taking physical delivery at $83.90, is pricing in something structural, something that doesn't reverse when ceasefire negotiations start. And that structural reality is a silver market that is in its 5th consecutive year of physical deficit, heading into what the Silver Institute is already calling the 6th. Annual mine supply globally runs at approximately 850 million ounces. Annual demand is running at over 1.16 billion ounces. That gap, roughly 230 million ounces in 2025 alone, doesn't come from thin air. It comes from drawdowns of above-ground stockpiles, vaults, exchange inventories. And those stockpiles, as we just walked through, are draining at historically unprecedented rates. Let me give you the industrial demand picture, because this isn't just about safe haven buying or war fear. Silver is sitting at the intersection of every major technology trend of this decade, and the numbers are staggering. Solar energy consumed 197.6 million ounces of silver in 2024, nearly 1 in 5 ounces of total global demand. And that was before the EU mandate for solar integration in new buildings kicked in at the start of 2026. Before Saudi Arabia's massive renewable build-out accelerates. Before China's solar installation pace, which outpaced the rest of the world combined in the first half of 2025, continues into this year. Electric vehicles are consuming 25 to 50 grams of silver per car, compared to 5 to 10 grams in a traditional internal combustion vehicle. That's a 3 to 5 times multiplier on automotive silver demand as the EV transition plays out, and the compound annual growth rate of automotive silver demand is projected at 3.4% through 2031. Not slowing down, accelerating. And then there's AI. Data centers running cloud computing, machine learning, and AI inference workloads consume silver in precision contacts, high-efficiency electrical components, and thermal management systems at levels that the Silver Institute's Oxford Economics report documented as following a 5,252% increase in IT power capacity since the year 2000. Every server rack, every switching array, every thermal interface, and every data center expansion that Amazon, Microsoft, Google, and Meta are currently executing, silver is in there. For manufacturers making solar panels, EVs, and AI hardware, silver represents a tiny fraction of total production cost. They are completely price inelastic at current levels. Running out of silver is simply not an option. They will pay whatever the market demands. And that dynamic, essential industrial demand that cannot be substituted, meeting structurally constrained supply, is the deepest structural driver underneath everything we're looking at. Now let me show you the smoking gun that connects everything. The paper-to-physical ratio at COMEX. As of late January 2026, the March 2026 silver futures contract represented 528 million ounces of notional exposure. 105,000 contracts times 5,000 ounces each. Set that against registered inventory, the metal actually available for delivery, of approximately 113 million ounces. That's a ratio of more than 4 to 1. 4 paper claims for every real ounce behind them. And as March deliveries process, that registered inventory number is falling. In January alone, COMEX warehouses experienced a 33.45 million ounce withdrawal in just 7 days. 26% of registered inventory vanished in a single week. The technical term for this kind of mismatch is counterparty risk. The real-world description is simpler. The poker table has more chips in play than there is money in the vault to back them up. Most of the players never ask to see real money. They cash in their chips for cash and walk away. But when a critical mass of players simultaneously says, "No, I want the actual silver," the math stops working. And this isn't speculation. This exact scenario nearly played out on October 8, 2025, when a single order for 1,000 tons of silver from India hit the London LBMA silver market and triggered an immediate freeze. Silver lease rates, the cost to borrow physical metal, spiked from 0.25% to 200% in hours. Not 5%, not 20%, 200%. Swiss refiner Metalor, which operates in 17 countries and has been in the bullion business for over a century, publicly announced it was withdrawing from the market until January 2026. The whole market stopped. That was a preview. And the response? More delivery demand. COMEX January deliveries 4.17 times above the prior year. February deliveries highest in history. March open interest at 4 times registered inventory. The market is not easing into resolution, it's accelerating toward one. Now let me bring in the China angle because this is the layer that most Western financial media is barely covering, and it changes the entire supply picture. On November 3, 2025, China announced severe restrictions on silver exports. And then on January 1, 2026, Beijing implemented an export licensing regime for silver, treating it exactly the same as rare earth elements. Only 44 companies received authorization to export silver under the new rules, giving the Chinese government gatekeepers over approximately 121 million ounces of annual exports. That's 60 to 70% of refined silver traded globally, according to analysis from Pareto Investor. To understand why this is seismic, consider that China exported over 4,000 tons of silver in the first 11 months of 2025, while importing only 220 tons. They were a net exporter, aggressively draining their own above-ground stockpiles, selling into the Western market. And then they stopped. Simultaneously, Shanghai physical silver premiums reached $5 to $8 per ounce above COMEX prices throughout late 2025. Chinese buyers were willing to pay a premium, in a global market where prices are supposed to be equalized by arbitrage, just to secure physical metal immediately. When the two largest holders of tradable silver, COMEX in New York and the LBMA in London, are simultaneously draining, and when the world's largest processor of silver, China, simultaneously shuts off exports and goes to premiums to secure domestic supply, you do not have a market with a temporary imbalance. You have a structural fracture. And into that fracture, JPMorgan is quietly loading silver at $83.90. Here's where I want to talk about the history, because this pattern is not new. It's just that most people don't remember it. In the late 1970s, brothers Nelson and William Hunt accumulated over 100 million ounces of physical silver, cornering approximately a third of the world's above-ground supply. Silver went from $6 an ounce in early 1979 to $49.45 on January 18, 1980, a 724% move in roughly 13 months. On March 27, 1980, when margin calls forced the Hunts to sell, silver crashed $10 in a single day, now known as Silver Thursday. The COMEX responded by changing the rules. They restricted trading to liquidation-only orders. The exchange essentially told the market, "We cannot honor the physical claims we've written." Sound familiar? Because the mechanisms unfolding in 2026 are structurally identical, just at a different scale, with different actors, and with a far more complex industrial demand component that the Hunts era simply didn't have. The paper-to-physical mismatch. The frantic accumulation of physical metal by the savviest players. The lease rate spikes indicating absolute scarcity of lendable metal, and a cascading delivery demand that the system was never designed to fulfill. The difference this time is the industrial demand floor. In 1980, silver demand was primarily monetary and photographic. If the price crashed, industry could manage. Today, solar panel manufacturers cannot swap silver for something else. EV battery management systems cannot function without it. AI data centers cannot substitute around it. The industrial floor is not $20 or $30. It's wherever production economics for those industries break, and that floor is rising every quarter. Let me give you the gold-silver ratio context because it helps clarify where we are in the cycle. The 25-year historical average gold-silver ratio is approximately 66 to 1. In April 2025, that ratio briefly exceeded 100 to 1, a level not seen since 2020 and historically extreme. What it meant was that silver was historically cheap relative to gold. As of early March 2026, the ratio compressed to approximately 57 to 1 as silver's January-February rally outpaced gold's. Gold is currently trading around $5,177 per ounce as of this week. JPMorgan's own analysts, the same institution now standing for maximum physical silver delivery, have a gold forecast of $6,300 by end of 2026. Deutsche Bank is holding a $6,000 target. If that ratio compresses further toward the historical average or below it, and gold hits even the conservative $5,500 target, you're looking at silver north of $90 just on ratio mechanics, before you add the structural deficit, the war premium, or the industrial demand floor. Now here's what I want you to think about practically, because I know the question you're forming. If silver is in structural deficit, if COMEX is draining, if JPMorgan is taking physical at $83.90, if China has cut exports, and if there's an active war disrupting global shipping, why is silver trading at $83 to $88 right now instead of $130 or $150? The answer is the paper market. It's that simple, and it's that important to understand. The COMEX paper price is set by futures traders, the majority of whom never intend to take physical delivery. They trade the momentum, the sentiment, the macro, the dollar index, the Fed expectations. Right now, some of those factors, dollar relative strength, interest rate uncertainty, and the chaotic volatility of the Iran war, are providing headwinds for speculative positioning. Paper traders are nervous, so the paper price reflects their nervousness. But physical market participants, the industrial users, the institutional buyers, the banks now standing for maximum delivery, are not nervous. They are accumulating. They are paying cash. They are taking the metal. And the divergence between what the screen says and what the vaults reflect is not something that resolves in favor of the screen. It resolves in favor of gravity. Physical reality always reasserts. We've seen this movie before at smaller scale. In October 2025, when London lease rates went to 200%, the physical scarcity was real, even while paper prices remained relatively contained. The lease rate was the screaming signal. Today, The delivery data is the screaming signal. Let me walk you through the practical implications because this is what matters for how you think about your own positioning and decisions. The first thing to watch, and I mean watch daily, is COMEX registered inventory. You can find this at cmegroup.com under warehouse reports. The number to track is registered silver specifically, not just total. When registered inventory falls below 80 million ounces while delivery demand for May remains elevated, you're watching in real time whether the paper-physical disconnect is widening or easing. Right now it's widening. Second, watch the Shanghai Gold Exchange premiums on physical silver. Those Shanghai premiums, which peaked at $8 over COMEX in late 2025, are a leading indicator of global physical tightness. When Asian buyers are willing to pay a premium above the official price, it tells you the official price is fiction relative to actual scarcity. Check those premiums weekly. Third, the silver lease rate. It's not publicly quoted in the same way interest rates are, but you can track it through the London Bullion Market Association and specialist dealers. When it spikes again, and the conditions that sent it to 200% in October 2025 have only become more acute, that will be the precursor to a physical squeeze that the paper market cannot suppress. Fourth, pay attention to the Iran war trajectory. The Strait of Hormuz situation is not resolved. As of March 11th, the IRGC fired on and stopped 2 vessels. Qatar's energy minister warned that if the war continues, Gulf energy producers may declare force majeure on exports. If oil pushes to the $100 to $114 range consistently, and Wood Mackenzie says it could if Hormuz stays disrupted, inflation expectations will reset sharply upward, and the investment case for silver as an inflation hedge re-accelerates on top of all the structural factors we've already discussed. Fifth, and I want to be clear, this is not financial advice. I'm an analyst, not your financial advisor, and you should always do your own due diligence. But the distinction between paper silver exposure and physical silver matters enormously in this environment. Futures, ETFs without allocated backing, and paper certificates all carry counterparty risk that physical ownership in your own custody does not. The difference between holding a piece of paper that says you own silver and holding a bar is exactly the difference between JPMorgan's old position and JPMorgan's new one. Think about which side of that trade you want to be on. Let me bring this full circle because I want to make sure the core narrative is absolutely clear. We started with $83.90 and 12 million ounces. Right at that price, with silver having crashed 13% from its war premium spike, JPMorgan, the institution that literally paid nearly $1 billion for manipulating this market on the short side, quietly reversed course and pulled physical metal off COMEX at maximum capacity. Not because $83.90 is the destination, because someone who understands the mechanics of this market better than anyone alive has looked at the delivery data, the registered inventory levels, the industrial demand projections, the China export restrictions, and the 6 consecutive years of structural deficit heading into a year where the paper-to-physical ratio at COMEX has exceeded 4-to-1, and decided this is the last moment to accumulate before the paper price has to reconcile with physical reality. Every time in history that this reconciliation has happened, the Hunt Corner in 1980, the LBMA freeze in October 2025, the London nickel squeeze in 2022, the paper market tried to hold the line until it couldn't, and the people holding physical metal when the line finally breaks are never the ones who bought at the top. They're the ones who looked at delivery reports and warehouse data and said, the math doesn't work. Not for much longer. The war premium in silver's price right now has been stripped out by paper traders. But the structural premium, the gap between what the futures screen shows and what an actual ounce of silver is worth to a solar panel manufacturer, an EV battery producer, or a bank that just delivered 12 million ounces off an exchange running on fumes, that premium is not stripped out. It's just not visible yet in the paper price. It will be. Let me end with something I want you to genuinely think about, not panic about, think about. The people who looked at Spanish trade flows in the 1500s and predicted inflationary collapse were called alarmists. The people who looked at Dutch tulip contracts in 1637 and said the paper claims outnumbered the real assets were ignored until they weren't. The people who looked at the Hunt brothers' COMEX delivery data in late 1979 and understood what was about to happen had a 13-month window to act before it was over. The people in October 2025 who watched London lease rates spike to 200% and Swiss refiners leave the market and said something is breaking here, they weren't wrong. The COMEX delivery reports are public. The warehouse inventory reports are public. JPMorgan's role as the dominant deliverer of physical silver in the January 2026 data is documented in CME filings you can read yourself right now. The Silver Institute's deficit numbers are published annually. None of this is secret. The only question is whether you're looking at the same data the institutions are looking at. And right now, the data says, the world's largest bank, which once paid nearly $1 billion for manipulating this market downward, has switched sides, completely, publicly, in the delivery records, at $83.90. That's the story. Everything else is noise. I want to hear from you. Drop a comment and tell me this. Do you think silver breaks above $100 before the COMEX registered inventory hits its next critical threshold? Or does the paper market suppress it long enough to let the big players finish loading? I read every single comment. Your perspective shapes what I cover next, and honestly, this community's insights have been sharper than most of the sell-side analysis I read. If you haven't subscribed yet, this is the moment. Hit subscribe right now because the May 2026 delivery data is coming in the next 4 to 6 weeks, and if it confirms what March is suggesting, the video I'm going to put out on this channel will be one you absolutely cannot afford to miss. This isn't financial advice. Do your own research. Talk to a qualified financial advisor before making any investment decisions. But do look at the data, because the data right now is speaking very, very clearly. I'll see you in the next one.